where we cover details on the main stories from the business perspective. The Bank of Japan kept the policy rate unchanged after its monetary policy meeting held the benchmark rate at 0% to 0.1%. Major shareholders are voicing strong opposition to BHP's $39 billion proposal to take over Anglo-American, calling it an opportunistic ripoff and fueling doubts over a deal that would combine two global mining companies. And the South African government may not be so enthusiastic. We'll find out why. Our main story focuses on the first quarter earnings releases of technology giants Intel's, Alphabet, and Microsoft. Microsoft shares rose 5% in extended trading yesterday after its latest quarterly results beat Wall Street's expectations. Microsoft Cloud also saw impressive growth on the back of artificial intelligence push. Alphabet shares soared over 12% in after hours as its revenue increased 15%, the fastest rate of growth since early 2022. And Alphabet also said its board approved a cash dividend of 20 cents per share to be paid on June 17 to stockholders and will now continue to pay quarterly cash dividends. Alphabet stocks could easily gain the 15% it needs to surpass a $2 trillion market value later today. Intel shares dropped 8% in extended trading after it missed expectations for first quarter sales and gave a weak forecast for the current quarter. Earnings still beat Wall Street expectations. It still saw related chip sales of $7.5 billion, up 31% year on year, despite slowdown in growth for PCs and laptops, which weighed on future forecasts. We also look at what we are learning so far from the results from big tech and how markets are responding. And in the US, fears of stagflation may be resurfacing as Q1 GDP came well below expectation at 1.6%, while a measure of inflation, that's the personal consumption expenditures price index, rose 3.4% for the quarter, its biggest gain in a year. The core inflation metric also rose at a 3.7% pace. Today we get the Fed's preferred deflator, the core PCE metric, and markets, however, are not waiting to confirm their worst fears that we may only have a single rate cut in December, and the possibility of a rate hike cannot be entirely ruled out as Treasuries yields inched up and US stocks fell sharply, closing all red. The Dow down 0.9%, the S&P 500 dropped 0.5%, and Nasdaq Composite also lost 0.7%. The US Bureau of Economic Analysis revealed that GDP expanded by 1.6% in Q1, short of predictions of 2.5% and after 3.4% growth in Q4 2023. The deceleration in real GDP reflected drops in consumer spending, exports, and government spending, partly offset by an acceleration in residential fixed investment and imports. Consumer spending fell from 3.3% in Q4 to 2.5% in Q1. Business investment sank from 3.7% growth in Q4 2023 to 2.9% growth in the last quarter, while inventories plunged from $54.9 billion to $35.4 billion in Q1 2024. Consumer spend is still decent at 2.5%, but shows signs of weakening, and government spend is expected to pick up after the $95 billion aid package has just been approved to support defense of Ukraine. Markets now see only one rate cut in December, and indeed, as we saw, equities sank. Treasury yields climbed 5 basis points to 4.706, hitting highest levels since November of last year. And there's a lot of nervousness from services inflation, which is now looking even stickier than initially thought. All eyes definitely on today's core PCE print, which looks set to be higher than expected, given correlation to earlier inflation prints. Microsoft announced earnings per share of $2.94 versus $2.82 expected on 17% year-on-year growth in its revenue, hitting $61.8 billion, beating 60.8 expected. Microsoft can already see artificial intelligence pushing its cloud revenues. Alphabet shares jumped 12% after hours when it announced its first ever dividend on top of beating on earnings and revenue. YouTube advertising revenue at $8.1 billion beats $7.7 billion expected, and Google Cloud revenue at $9.6 billion also beat market consensus. Q1 numbers show also that the core advertising business is now reaccelerating after a difficult 2022 and 2023. Yesterday, we saw markets digesting Meta's results after Tesla's with different reactions. Though Tesla missed on forecasts, it was able to see a double-digit rally driven by narrative and guidance, which sold well to investors. Efficiency moves, measured AI spend, and cheap EVs coming sooner after shares sank 45% year to date sounded like a reasonable response. Meta announced impressive beats above Wall Street, but said that expected Q2 revenue would come in a range with a midpoint of at $37.75 billion below expectations for $38.3 billion. And additionally, it asked for patience to spend significantly more on AI infrastructure, which wasn't convincing, with shares looking already expensive, up 50% year to date. Meta's foray with Metaverse already makes it appear to be spreading itself too thin. But the other good news from Meta didn't seem to matter. Earnings per share of 4.71, beating the consensus on revenue of $36.46 billion, also comfortably surpassing expectations, did not impress investors. What are markets and investors looking for, especially when we consider technology stocks? First is monetization of artificial intelligence. Microsoft has infused AI into its mainline lines of business successfully, such as cloud computing contracts and subscriptions for its email and other online services, and can show a clearer monetization path. And AI-related growth in its cloud services is already apparent. Nvidia is also benefiting from all the capital AI expenditures from the downstream players. Efficiency is another issue. Inflation now stickier means a hold on costs matter, and shaving fat rings well with investors. Alphabet, Tesla, and many others have been cutting costs in anticipation of slower growth and tight margins. Resilience to recession definitely is key. How resistant is the business model to stagflation? Tesla's focus on cheap EVs sooner was a hit with markets, given where consumers are with their wallets. Future guidance obviously is important. Growth tech stocks are priced for the future and not the past. And though fundamentals still count, price multiples count, share buybacks and dividends sell well in returning cash to shareholders who are running out of patience, it's very important that the guidance also is upbeat. Alphabet first ever dividend definitely went down with markets. The trade-off associated with capital spending versus profits also needs to be clearer, and markets are making their own judgment calls on whether cash chests are being squandered on certain plays. Meta's message of more spending when revenues were struggling looked cloudy to investors. And issues like cybersecurity also coming up. For example, the Federal Cybersecurity Safety Board issued a report after Chinese cyber operators broke into email accounts of senior US officials, saying Microsoft is shoddy with its cybersecurity practices, and concludes that its security culture was inadequate. And then, of course, there are several other antitrust cases coming up with the US DOJ, Department of Justice, coming after a lot of these large tech companies. We could see the Nasdaq, of course, later today boosted by Microsoft and Alphabet earnings as a result of the strong results and guidance. The world's biggest mining firm, BHP, wants to buy its rival, AngloAmerican. Headquartered in London but founded in South Africa since 1917, the deal could go for $39 billion. Anglo is the world's largest producer of platinum, and the thinking is that this comes at a time when Anglo has seen its latest annual profit plunge by 94% in 2023 and shares depressed, if not significantly undervalued, according to shareholders who are opposing the deal as opportunism, calling it an opportunistic deal which doesn't factor the huge potential of its copper assets. BHP's portfolio is not as diversified as AngloAmerican, and BHP definitely has an eye on Anglo's copper mining assets in Chile and Peru. While 50% of platinum demand comes from its use in catalytic converters for cars, trucks, and buses for internal combustion engines, copper is a major component in electric vehicles used in electric motors, batteries, inverters, wiring, and in charging stations. BHP has already said it will expect Anglo to spin off its diamond and platinum assets ahead of the acquisition. The tie-up also gives BHP 10% of global copper mine supply ahead of what many say is an expected shortage. That could send prices soaring. BHP could also overtake other rivals by this deal, trying to position themselves for the global energy transition. Meanwhile, BHP shares fell 4% at close yesterday as investors feared it may be paying too much, eroding profits, especially if it has to sweeten its offer. But why is South Africa's Mineral Resources Minister Gwede Mantashe telling the FT that his country's experience with BHP was not positive, although this is not an official government reaction? Indeed, many African countries feel a frustration that the likes of BHP appear to take advantage rather than collaborate to support the sustainable development of host economies. While hundreds of battery production and EV factories exist across Asia, North America, and Europe, if you look at Africa, there are only a limited battery assembly operations. Say in South Africa, the African Continental Free Trade Area has placed the lithium-ion battery value chain as top priority in a lot of their ventures, and the DRC, Democratic Republic of Congo, and Zambia, being the largest producers of copper, have plans but have made little progress beyond extraction. South Africa and Morocco have announced plans to build the lithium-ion batteries, that's factories beyond basic assembly. This has to be the time to accelerate value add in Africa and change the paradigm of focus on raw material extraction only to be a vast market for imported EVs as an energy transition revolution gathers momentum globally. Unfortunately, leaders have chained Africa to a resource-based economy mindset where wealth is determined by how much we can extract and export of our resources. While what is even worse is that with excessive government participation in key resources like oil, the likes of NNPC, for example, should long have been in private hands. We have inefficient economies where productivity is very low, and we are not just sub-optimizing, outputs are being wasted, if not outrightly stolen. But beyond looking for efficiency, we need an accelerated path to a knowledge economy driven by technology, innovation, and the production and dissemination of knowledge rather than natural resources. Africa urgently needs leaders that can leverage its strengths to leapfrog through courageous reimagination to help countries accelerate to emerge as knowledge economies, so we have our own Googles, Meta, and Nvidia. That's it from me on Global Business Insights. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.